What if I told you there was one number, just one, that could help you look past all the hype and see the real quality of a company? Well, today we're going to demystify that exact metric, return on invested capital. It's really the key to understanding what makes a business truly great. So let's start with a question that seems, kind of obvious. If a company is making a profit, it's got to be a good business, right? But believe it or not, that's not the whole story. A company can be pulling in millions in profit and still, slowly but surely, be destroying its own value. How on earth is that possible? Well, it all comes down to how efficiently it uses its money. And that's where our solution comes in. It's a powerful metric called return on invested capital, or ROIC for short. This is the tool, this is the lens that helps us separate the companies that just make money from the companies that are truly high-quality, efficient machines. So what is it exactly? At its core, ROIC just measures how good a company is at using the money that's been invested in its main operations, its factories, its software, its inventory, to actually generate profit. You can almost think of it as the ultimate report card for a company's efficiency. Let's boil it down to the simplest possible question, because this is really all ROIC is asking. If you give a company $1 to run its business, how many cents of profit does it hand back to you after a year? It's that simple. It's that fundamental. All right, enough with the theory. Let's make this real. Let's make it concrete with a super simple example. We're going to build a company's ROIC from scratch just to see exactly how the sausage is made. And the formula? It's actually really straightforward. On one side, you have the profit the business makes from its day-to-day operations. And on the other, you've got the invested capital. That's all the money from owners and lenders used to build and run the thing. We're just going to divide that profit by the capital it took to make it. So let's imagine our little company has $5,000 of invested capital. This is the total cash that its owners and its lenders have put into the pot to fund the whole operation. Okay, now using that $5,000, the business gets to work and generates $750 in operating profit for the year. And that's the pure profit from its core business, nothing else. Now, we just do the math, 750 divided by 5,000, and that gives us an ROIC of 15%. So what does that mean? It means for every single dollar invested in this business, it kicked back 15 cents of profit. Okay, great. We have our number, 15%. But a number by itself is totally meaningless, right? And this is where ROIC stops being a simple calculation and starts becoming a really profound insight into a company's actual health. And that's the real question, isn't it? Is 15% something to pop the champagne for, or is it actually a red flag? The answer might surprise you, because it depends entirely on one other absolutely crucial factor. And that factor is the company's cost of capital. Just think of it like a hurdle rate. The company has to pay interest to its lenders, and it needs to provide a return for its shareholders. The cost of capital is just the average cost of all that money. It's the bare minimum return the company has to hit just to break even from a value perspective. And this, right here, is the moment of truth. This is the whole ball game. If a company's ROIC is higher than its cost of capital, it's creating value. It's a winner. But if its ROIC is lower than its cost of capital, it's actually destroying value, even if it's technically profitable. It's not enough to just make money. A great business has to earn more than its capital costs. Now, this very ability to measure true value creation is why so many analysts consider ROIC to be a complete or even a master metric. It tells a much deeper, much richer story than a lot of other financial ratios you might see. So what's so special about it? Well, for one, it looks at all the capital the company uses, money from both owners and lenders. That gives you a complete picture of its efficiency. It helps us find companies that aren't just growing, they're growing with quality. And that is the hallmark of a really solid long-term business. To really appreciate its power, let's put ROIC in the ring, head-to-head, with a few other return-on metrics that you've probably heard of, like ROI and ROA. So take a look at this. You've got ROI, return on investment. That's great for figuring out if one specific project was a good idea. Then you have ROA, return on assets, which is good for gauging overall asset efficiency. But ROIC is like a surgeon's scalpel. It focuses only on the capital invested in the core business, which makes it the best tool we have for judging the true quality of a company's operations. So in the end, ROIC isn't just another piece of financial jargon to memorize. It's a lens. It's a way of seeing a company's financial DNA, its fundamental, raw ability to efficiently turn $1 into more than $1. And that leaves us with a final thought, a little homework for you.
Think about the companies you really admire. Now that you understand ROIC, ask yourself, are they truly creating value or are they just running on a financial treadmill? Answering that question, well, that's the power of looking past the noise. I hope this helps you see the world of business in a whole new light.